I'm Mike DeSepoli, and welcome to the Heritage Market Pulse for Friday, February 11, 2022. We hope you're all having a great week. Markets are trying to complete the third positive week in a row here, so we're back. We want to update you on the markets, the economy, and the news flow, which there is certainly a lot of it, the surrounding our investments and how we think we move forward from here. So as I mentioned, markets are trying for their third positive week in a row. We just midday got some news about a potential Russian invasion into Ukraine. So you couple that type of news with Friday light volume, which is generally a characteristic that we see in the markets on Fridays, less trading, less shares changing hands, tends to exacerbate the moves a little bit. So markets are down today about 1.5%, but working on, like I said, their third straight positive week. So it's very close to, as of right now, to see if we'll get that third week in a row. But nonetheless, we're seeing positive action in the markets. I want to highlight some of that here today. So let's start with the S&P 500 as a visual representation of this market. So what I've drawn on the screen here is we're looking at the last year in the market and the correction that ensued coming out of last year into January. And what we believe is a very important line in the sand, levels that we are watching, is the low from Monday, January 24th. So we believe the markets did put in a correction bottom on Monday, January 24th. That was that big move down lower where we saw the broad indexes down 3-4% each for that day, reversing around midday and finishing higher. Since this low here in the market, which we believe will hold, we've seen the markets move up pretty swiftly in a short period of time, and now we're getting a little bit of a pullback, a little bit of a breather, if you will, a little bit of consolidation. So in our world, in studying the technicals of this market, we want to see this low hold. It would not be abnormal for the market to backtest a little bit to give the appearance to folks that it's going to roll over. We would call that a bear trap. Bring in all the bears again, get people bearish, get people negative, get people pessimistic, and then trap them somewhere in this area as the market launches higher out of that area. On the shorter term time frame, again, just zooming in, nothing changes, right? This is the market low that we think has established itself on 124, and since then we have seen the markets move up off of that. The action that we've seen since this low has been very constructive, and it's been exactly what you want to see. So let's take a look at our heat map here, right? This is the market broken down by sectors and capitalization, right? So the larger a company is in size, the larger the square on the screen, and we have it broken down by grouping so we can see where the money flows are and what type of activity we're seeing in the market. Now, since the market bottom, which has been really almost 3 weeks ago at this point, the sectors that were the hardest hit in the correction are the ones that have led us higher in the near term, and that's exactly what you want to see. And when you look across the market here, we've started to see some of the areas that were more defensive, right? The areas that did okay during the correction, the real estate and utilities, which held up fairly well. These are now the areas that we're starting to see sell off. And the areas that were hit the hardest, which has mainly been our software grouping, we are starting to see significant outperformance coming off of the lows, which is what we would expect to see if this was indeed a correction and not a crash, which we believe. Heartburn, not a heart attack, right? So now looking at this, and you know we own a fair amount of software and growth names, we started to see companies to the likes of Chewy and Roku and et cetera, where the market has moved up 5 to 7% off its recent low. Some of these stocks are up 20 or 25% off these recent lows. And this is kind of the story we've been trying to tell for quite some time, to say, look, we understand corrections are brutal, they're fierce, they're swift, they can be vicious at times, and some of the high grower, the more compounding growth names are the ones that tend to get hit the hardest. But these are the companies that we think will lead us out of this. We think they will outperform on the way up. And we think, even though this is a short period of time, you just look at, we don't own all these names that you see on the screen here, but a lot of these companies up 20, 25, 30% just since the January 24 low. And actually some of these even just over the last week. So we expect to see this type of activity continue. But one thing we have to remember is bottoms are generally messy, right? So we do believe that we have a bottom here in place, but that does not mean if we do some back testing, if we roll over a little bit, if we show a little short-term buying exhaustion, that doesn't mean that all bets are off and we're going to go back and take out the lows and resume the crash. So, what we're seeing here midday, let's look at this week in the markets, right? Just as of yesterday, markets were pushing up against a weekly high. Then we had one of the Federal Reserve governors who gave a speech around midday yesterday, started to opine for quicker and faster interest rate increases. So markets got a little tripped up over that. And then today, with a little Ukraine-Russia news, talks about a potential invasion, we're starting to see the market sell off a little bit again. Putting this in context, right? Still holding well above this low, which is fine. We had the initial bounce, a little bit of a back test, another bounce, and another back test. This is normal market activity. Markets don't move in straight lines. And while the moves down tend to feel like straight lines, we know that as markets start to rally, they will do so in ebbs and flows. So let's talk about the major news flow this week, right? Most of you, everybody really at this point is fully aware we're experiencing inflation. It's the highest it's been in 40 plus years. And yesterday we got confirmation of that. With the inflationary reading from January showing a year-over-year increase of 7.5%. I don't think this number surprises many people. If you're out there in the real economy, you're probably seeing increase in goods and services more than 7.5%, right? We know that used cars, new cars, certain service-based businesses that deal with different products that they're getting from overseas are seeing major increases in costs there as well. So this is kind of the whole catalyst behind the narrative of higher interest rates, right? Is the Fed has to fight inflation by raising interest rates. And just to scroll down here, we can see here's inflation since 1980, right? Obviously, we've seen higher inflation back in the 80s, and it took the Fed some interest rate increases to get this under control. We think this scenario is a little bit different, right? Because the Fed normally can raise interest rates to combat inflation, but raising rates will not fix supply chain issues, and that's a lot of the cause for the inflation that we're seeing. So, yes, we know the Fed is going to raise interest rates. There's the expectation that they'll do it in March. We would actually encourage the Fed to come out and do that beforehand. There's no need to wait 6 weeks. The market works to price in these probabilities ahead of time, so we know that the market is already grappling with higher rates. It's just a matter of how high rates will be. And again, we think they'll raise rates 25 to 50 basis points. They'll probably do it 2 times, maybe 3, but not 5, not 6, and not 7 times at all. Now, another thing we had in the news today, which is very relevant to the way the financial markets are behaving, is the University of Michigan consumer sentiment, right? How do consumers feel about their personal finances, about the economy, and about the path forward? And we're seeing some very interesting things here, is that inflation is obviously starting to wear on the consumer, right? So we know consumer sentiment cratered last year through the pandemic. We had lockdowns, we had shutdowns, and this would naturally weigh on consumers. But we had a nice bounce off of that, right? Consumers were rebounding. We come into April of last year, things were looking better, people were feeling better. And then this inflationary problem started to come about, and it is weighing on consumers. And we're in a very interesting place now where the consumer feels worse today than they felt in March of 2020, which is really kind of hard to believe. But when you see increases in prices like we've seen, it's not abnormal to see these things weigh on the consumer. So I mentioned this to you to show you that this is another tool, another data point that the Fed needs to keep in mind, right? Because they want to raise interest rates, but we have to be very mindful of the U.S. consumer. This is a consumer-driven economy. Most of the consumption, about 70% of consumption in our economy, is consumer-driven, and we know that it's a major contributing factor to GDP. So while the Fed will look to raise rates, number one, they are cognizant that higher rates will not fix the supply chain, and number two, they're cognizant of the fact that the consumer's feeling the effects of inflation a little bit, and while they want to help the consumer get inflation down, they don't want to just go ahead and crush the consumer and totally destroy confidence, because if they destroy confidence, people will hold on to their money longer. So in the general scheme of things, we do believe that the market has put in a successful bottom in this correction. We do expect the markets to make a move back to all-time highs. It will not be in a straight line. So we expect a little back and forth here as the market wrestles within underneath the surface. But speaking of under the surface, that is something that has shifted dramatically in this market. We are starting to see major improvement in the internals of this market. So when we went back to, just a couple short weeks ago as the market was rolling over, there was really no strength to be found under the hood, right? There was no leaders in the marketplace. Companies were just kind of falling under the weight of the market. And since this bottom has put in, we've started to see an improvement in earnings reports that have come out, improvement in the reaction to those earnings reports, as we've seen companies, big mega cap tech companies like Apple and Google and Microsoft and Amazon come out and say, hey, listen, we still see good days ahead. We still see continued expansion in our companies. And yes, while the supply chain has some issues and quirks to be worked out, we still can see a path to future growth and future profitability continuing. And that was really what the market needed to hear. So we think we're in the midst of probably the most important earnings season in a decade, right, for validation for this market. And so far, so good on that front. So we don't make much of the action over the last 2 days. Market's moving down a little bit into the weekend. That's quite all right. People are a little nervous about Russia and Ukraine, what news might break over the weekend. So it has investors probably just taking a more cautious approach right now. We see the recent pullback as a buying opportunity. We know that January was the worst one on record going back 40 plus years. And again, I know I've repeated myself on this a lot, but the narrative around interest rates has been the same every time over the last decade that it's come about. There's a lot of fear about it. People talk a lot about it. The Fed governors do a lot of opining in public, commentary to try to talk into the market some of the expectation for these rate hikes. But again, the history is very clear on this. Interest rate hikes are not bad for stocks. They are bullish. They are good for markets. When we look at the first 3 to 4 rate hikes, markets perform very well during that period of time. And let's face it, folks, right? If inflation is going to be persistent, we do think it'll inflect down eventually. But if it's going to be persistent through the rest of this year, the best place to protect yourself is real assets. That's real estate and stocks. That's what we're doing here. We think your money is being well put to work to protect you against the erosion of your purchasing power. So again, good constructive action from January 24th, coming forward. We'll look to see some continuation of the uptrend next week, barring any type of escalation of the geopolitical conflict going on or potentially going on in Ukraine. So if you have any questions, reach out to us. We just want to give you some perspective on what we see in this markets. We remain bullish. Our targets remain much higher than current levels. We're using this as a buying opportunity, and we think the vindication will come soon enough. If you have any questions, reach out to us. We hope you have a great Friday, and we'll see you back next week.